Hi, Lee Phillips here. I want to talk to you about controlling income taxes for a minute. This is a big deal, guys, because in the asset protection world, which I do a lot in, and we use corporations and LLCs and all of these things for asset protection, your biggest asset protection threat is the IRS. They're taking half of what you get. Oh, don't give it to me that they only get 20%. No. There are all kinds of taxes, property taxes, and yeah, I know there's state taxes, and so it's not really the IRS, but you're getting killed on taxes, bottom line. So we need to control taxes. There are basically three ways that you can control taxes. Let me go through them with you for a minute. And all the tax strategies are kind of based upon these three underlying principles. One, we can postpone the tax. Two, we can shift the tax. Or three, we can change the nature of the tax. That's pretty much all tax planning, right there. Let's go through them. You can postpone the tax. Give me an example. Well, how about a 401k? I get to deduct the money I put in, or standard IRA, deduct the money I put in, it grows without the tax, and then I pay the tax later. How about a 1031 exchange in real estate? Is that postpone the tax? We kick the can down the road for a while. And in the meantime, I've got the money, the IRS doesn't have the money, and so I get to use the money to invest and to make more money. Time value of money, it's critical. So I can postpone the tax. I can shift the tax. That means that we have to have somebody else pay the tax, or we get to have somebody else pay the tax. So if I'm making income in my company and I can shift it so that my children have to pay the tax, maybe I can save some tax. Or I'm supporting mom and dad these days. I make it so mom and dad have to pay the tax. I'm giving them money anyway. Why not give them a pre-tax dollar and have them pay the tax? What's the big deal there? Well, the big deal is they're in a lower tax bracket than you are. You're the owner of the company. You own everything today. And you're making a lot of money. And you're in this big high tax bracket. Mom and dad, they're retired. They need money. They're in a lot lower or a zero tax bracket. So we can shift the tax and have somebody else pay the tax. We can change the nature of the tax. What do we mean by nature of the tax? Well, if I make an investment and I hold it for 8 months and sell it, is that different than holding it for 15 months and selling it? Yeah. This has a capital gains tax. This has an ordinary tax. If I earn money by selling widgets, that's ordinary income, subject to Social Security, FICA, FUTA, everything else. If I get money from rents, is that different? Yeah, that's passive income. So one of the objects in tax planning is to turn ordinary income into passive income. And it saves us a lot of tax, approaching 20% in many cases. So if I can change the nature of the income, then I can control the tax. Now, I want to say something. And that is, when I shift income and make somebody else pay the tax, I cannot shift earned income. I can only shift passive or unearned income. We had a steel mill here in our part of the country a while back, and these brilliant financial planners, they went in and they got the steel mill to cut checks. Dad had his check, and then each kid got a piece of dad's wage, and they were shifting income. And they actually set it up through the steel mill so that dad earned his $100, but he only got $60, and each one of the kids got 20 and 20, 40%, 40. So we had, $100 taken care of. Dad got 60, kids got 40. They're in a much lower tax bracket. The IRS came back in a few years later and said, no, wait a minute. We can't do this. And they had a heyday. They went back, they redid everything, and they, everything. So you can only shift passive income. The way we do it is we set up the company, the doctor. The doctor has equipment, x-ray machines, tables, all of that sort of stuff. And we put that into a separate company. Daddy earns the money as the doctor. That's earned income. But he rents this equipment to himself. Now he could go down and he could rent it from Ace Rents or wherever you rent medical equipment from. And he would pay Ace Rents the rent. They would get that money. That's passive income to Ace Rents. Well, in this case, the company is set up with the children as the owners. So dad earns the money as the doctor, pays rent for his equipment. We've now done two things. We've changed the nature of the tax. It's not earned income down here with the kids. It's passive income. And we've made it so they pay the tax on it. Now we have kiddie taxes and everything we have to worry about. I have another YouTube video on kiddie taxes, so you have to look at that. The IRS is trying to clip the wings of daddy moving all the money down to the kids. No clip on moving money up to mom and dad though. So where do you want to move it to? That's an issue. But this concept of shifting and changing passive, active, earned, unearned income is a big deal. You need to understand it if you're going to really do tax planning. And the neat thing about it is, if we do it in the companies, that's above the line instead of below the line. If you don't know what above the line and below the line is, you'd better look at one of my other videos, because that's a critical issue in controlling your taxes. This is Lee Phillips. Controlling taxes is a big deal. I'll tell you that.